Hey, welcome. If you've ever felt like investing is just way too complicated, you are in exactly the right place. Today, we're going to cut right through all that noise with a super simple guide to get you started building wealth. Seriously, what if the next 5 minutes could actually change your entire financial future? That's our goal here. We're going to give you the absolute essentials you need to get going. No fluff, no confusion. Okay, so first things first, why even bother with investing? Well, it really boils down to two powerful forces. One of them is quietly working against you day in and day out. The other, it can be your best friend, but you have to put it to work.
Have you ever had that feeling? You look at your bank account, you look at prices, and it just feels like your money doesn't go as far as it used to? Well, guess what? It's not in your head, and a simple burrito can show us exactly why.
Think back with me, just 6 years ago, you could walk into a Chipotle, order your favorite burrito, and it would cost you about $8.50. A pretty normal price for lunch, right?
Now, let's fast forward to today. That same exact burrito is now around $12. Your money's buying power has literally shrunk. Put it this way, if you had $50,000 today, you could afford over 1,700 fewer burritos than you could back then. And the culprit is the silent thief we call inflation.
And here's the key thing to get. Inflation is just this steady rise in prices over time, which means the cash you have is losing value every single year. With the government aiming for about 2 to 3% inflation, letting your money just sit in a bank account is a guaranteed way to lose purchasing power.
Okay, so if holding cash is a losing game, how in the world do you fight back? Well, you need to use a force that's even more powerful than inflation. And that force is compound interest. This is the real magic behind building wealth. It's not just about your money earning a little something back. It's about those returns then earning their own returns. It creates this snowball effect that just grows and grows and grows over time. And the power here is just staggering, even if you start small. Check this out. Imagine you invest just $1,000. If you let it grow at the market's historical average of 10% a year, in 20 years, it could become more than $6,700. All without you lifting another finger. That's your money making money for you. That is the power of compounding.
Okay, so you're on board, you're ready to invest. But now the big question is, what on earth do you actually buy? There are thousands of choices out there, but for a beginner, we want to keep it super simple and really, really effective.
You basically have two main paths you can take. You could try to pick individual stocks, like trying to find the next Apple or Tesla. But this takes a ton of research, it's super volatile, and honestly, it's really high risk. I mean, if you bought Intel stock at its peak back in 2000, you'd still be down on that investment today. Ouch. Or you can take the simpler, more diversified path, an index fund.
An index fund ETF is an incredible tool, especially for beginners. Think of it like a basket that holds tiny little pieces of all the big companies in a major market index, like the S&P 500. So, with just one single purchase, you're invested in the 500 largest companies in the US. That's what we call instant diversification.
And to actually buy one of these, all you need to know is its ticker symbol. The best analogy is to think of it like an airport code. JFK gets you to New York, LAX gets you to Los Angeles. Well, in investing, a ticker symbol like VOO gets you an S&P 500 index fund. Simple as that.
So, we know the why and we know the what. Now, let's get into the how. We're going to walk through the actual practical steps to make your very first investment. And I promise it's way easier than you think.
First up, you need a place to actually hold your investments. You've got two main choices. On one hand, you've got retirement accounts like a 401k or an IRA. The pro, amazing tax benefits. The con, that money is pretty much locked up until you retire. On the other hand, you've got a standard brokerage account. It's way more flexible. You can get your money anytime, but you will have to pay taxes on your profits. For a beginner, a brokerage account is often the easiest place to start.
Look, the whole process really breaks down into just 4 simple steps. Step 1, open a brokerage account online. Think Fidelity, Schwab, Vanguard. Step 2, link your bank account and put some money in it. Step 3, search for that ticker symbol like VOO for the S&P 500 and place your first order to buy. And the final step, Step 4, set up an automatic recurring investment. That's it, you're officially an investor. All right, now we've reached what is probably the single biggest mental hurdle for anyone new to investing. Timing. When is the right time to buy? Is right now a good time? Did I miss the boat? Let's tackle this thing head on.
I love this quote from financial blogger Nick Maggiulli because it just simplifies everything.
He says, rather than worry about whether now is the right time to buy, just keep buying. Market high or market low, doesn't matter. Just keep buying. The goal isn't to be a market genius, it's to just be consistent.
But I know what you're thinking. Hang on, the market just hit a new record. It feels like the absolute worst time to buy. And look, that's a totally normal fear. But the data? The data tells a completely different story.
Just look at these numbers. Over a 30-year period, if you had tried to jump in and out of the market and you missed just the 10 best days, you would have cut your potential gains by more than half. Missed the 20 best days, you've lost almost 3/4 of your returns. The risk of sitting on the sidelines is so much bigger than the risk of buying at what might be a temporary peak.
So the practical way to just keep buying is a strategy with a fancy name, dollar cost averaging. But it's really simple. You just invest a set amount of money, say $100, at a regular time, like every single month. When the market's high, your $100 buys a few less shares. When the market's low, it buys more. It completely automates the process, takes all the emotion out of it, and makes sure you are always in the game.
So let's wrap this all up. What are the big takeaways? Number 1, holding cash is a losing game because of inflation. Compound interest is your secret weapon for growth. 2, index fund ETFs are your best friend for simple, instant diversification. And 3, and this is maybe the most important, don't try to time the market. Time in the market is what matters. The best way to do that is to automate everything and just keep buying.
So I'll just leave you with this final thought. Over the long run, the stock market has historically grown wealth 44 times more than inflation has destroyed it. The whole system is basically set up to reward the people who participate. So the only real question left is, what's that first simple step you're going to take today?